Good afternoon, everyone. This is Colette, and welcome to week 4 of Planning for Profit. This week's topic is financial planning and analysis. We have 3 speakers today. Cinda, if you can go to the next slide. Barbara Leachman with the Idaho Small Business Development Center is going to talk about financial planning and analysis and developing a business plan. Stan Ehrman, who is the owner of Riley Creek Blueberry Farm up in Laclede, Idaho, is going to talk to you about how he uses his business plan in making decisions on his farm and what that has resulted in changes on how he does things on his farm. So welcome, Stan. We're really happy to have you. And then Ken Hart with University of Idaho Extension is going to be talking about farm financial planning and specific ways that you can do some analysis by creating different types of reports. So Cinda and I are facilitating the webinar. So we're running things in the background. As I've said before, please close all the other programs running on your computer so that your side of running the webinar is optimized, and check your sound. You can always call in if you're running into problems with clarity and speed. And then if you do call in on the phone, just a reminder to mute your computer when using your phone, and that you can type in questions during the time of each speaker. We'll have a short question and answer period after each. So please go ahead and type them in as they come to you, and that will facilitate the question and answer section. And I just wanted to take a moment to thank you all for being so patient with the technological side of the webinars. The way this works is all of your presenters are in different locations, and depending upon how rural they are, or how the weather is, their internet connection may be stronger or weaker each week, and that's why sometimes you see on our side there's a delay in the slides being changed from one to the other, or a little bit on the sound. And we actually have the presentation running off of one computer, and we hand the mouse off to different presenters often so that they can move through their own slides. So there's just a lot of things going on in the background, and we really appreciate your patience when they have a little bit of glitching during the webinar. We try to make it as smooth as we can, but sometimes a few things get out of control. So with that, I want to go on and move on to Barbara, and thank you for being with us this afternoon, Barbara.
Well, thank you, Colette. My name's Barbara Leachman, and I'm with the Idaho Small Business Development Center at Lewis Clark State College, and we do lots of different things, and it's a fun job. Located in Lewiston, Idaho. This is DJ. He's one of my shelties, and I used to be in 4-H and have taught dog obedience classes and that sort of thing. But today, that's not going to be what we're talking about. We're going to be talking about financial planning and analysis. One of my favorite subjects, although I know taxes and planning are not necessarily a favorite subject for everybody. By this time, you probably realize I'm a fan of Richard Wiswall's book on Organic Farmer's Business Handbook, and so we're going to be talking about chapters 8 and 10, at least the first part of chapter 10 with what I'm talking about, and a little bit of philosophy thrown in. So at the end of the year, we've already talked about keeping records and doing some calculations and projections, and now we're going to get into a little bit more of the investment side of it. And so at the end of the year, you or your accountant will close out your profit and loss analysis. That's where you've recorded your income and expenses, and transfer your profits, hopefully a positive bottom line, but that can be negative. But that total will get transferred over to your balance sheet into your equity or retained earnings account. So the total left over in equity is going to be the owner's investment that you have put in over the years or when you originally bought the farm, and profits that you've left in the business, and then minus what you've pulled out for owner's draws or if you're incorporated as dividends. Let's see if I can get this to move ahead. So one of the things we're going to emphasize here, that net worth is not self-worth. You need to disconnect those two. Self-worth is more about your integrity and your self-esteem. Net worth might be more about what you've inherited or maybe your income over a long period of time. One of Wiswell's quotes is, "A farm needs to generate wealth in order to survive." And so we're going to be talking, I'm going to use interchangeably a little bit net worth, equity, and wealth. So I call this a personal values check, a little bit of thinking about your financial needs versus wants. So we all need our basics covered: food, shelter, in this day and age, health care, fuel, transportation. But we might question ourselves a little bit about whether more money, more income, or more wealth leads to security, freedom, less worry, less hard work maybe. That's one of my goals, I've got a tractor now to move the dirt around. And then what we want. If you haven't done the Chapter 1 Personal Values Worksheet, I encourage you to do that. It is a good way to examine some of those values and how we're thinking about where we're going. Now we're going to get into a little bit more on talking about decisions related to making money. So you're going to have choices to make if you have some profits, and whether or not you're going to invest that income, how you're going to invest it, and I recommend people check their ego in the back room when they are looking at making these decisions, because I've known too many people who let their ego get them into trouble. So the kind of decisions we're talking about are, I think I hit the deal one too many times, so I'm going to take us back up a couple of pages here. So unless you're very wealthy, which happens in some places, regular profits are necessary to live and continue operation. So we're going to be looking at some of the choices that you're going to be able to make, and I just wanted to say that, you know, I worked as a lender and I worked as a financial counselor, and I've seen too many people who have borrowed too much money and have, as a result, a little problem can quickly turn into a big problem. Foreclosures can be really tough to be around, or for people to experience. So you've seen the accounting equation before, and I just want to emphasize that your profits left in the business become your equity or wealth, but only if left in the business. You can withdraw your equity that you have earned, your profits or investments that you've made in the business, to meet your basic needs, to meet personal wants. You can invest off the farm, invest in farm assets, and you can use your profits to pay down debts. It's just a list of some of those important choices that you have decisions to make around. So I encourage you to consider the team. You may have family involved in this. You might have an attorney, an insurance agent, of course an accountant, but particularly family. So involve everyone in these decisions as appropriate. Different people involved may have different values. You want to consult each other. Be respectful. When you make those projections, be honest with yourself and with others. We can't afford it all. But I do point out, at least with my property, a snow plow is required, even though it might be a vacation home. I have a vacation home, but I have never been to Hawaii, so those are the kinds of investments you can see that I make. So some tidbits of from my accounting wisdom here. Wealth building versus spending. Negative profits reduce wealth, obviously. Wiswell says to save money, you must spend less than you bring in. I have said that for a long time, and yet I have seen, again, too many people who are borrowing against their equity, against their wealth, against their 401k, and think of that as income. Loan proceeds are not income. Paying off debt is not an expense. I'm using accounting terminology here, but it's one of those fundamentals about decision making if you do have the cash. And the value in equipment is the measure of increased profit only. Okay, just a tad bit about depreciation because it comes into play in association with taxes and about purchasing equipment and those sorts of things. So you probably already know this, but capital purchases are not deducted from income entirely in the year of purchase. The cost of the item is depreciated and deducted over its useful life. So some people may not want to reduce want to reduce their taxes by purchasing depreciable assets. And so if you go out and purchase a $40,000 vehicle and you're in a 25% tax bracket, and let's say you can depreciate that vehicle out over 4 years, although the government plays with the tax code, and in recent years we've been able to depreciate certain kinds of things a lot faster than normal. What that does in effect is it decreases your income now but increases your income later. So we'll talk a little bit more about timing and taxes in a couple minutes. But in this example, I'm saying, should I purchase a new truck to take advantage of the tax deductions? And so we have to make some assumptions here, like what kind of tax bracket you're in. If you used straight line depreciation, that would amount to about $10,000 per year, so that's the $40,000 divided over 4 years. And looking at your income, let's say if you're in that 25% tax bracket, your income is about $80,000 a year. And then I put a finance rate of 8% on there because current finance rates just don't seem to be very significant. So now we're looking at a reduction of income by about $10,000 because now we have this new truck to depreciate. And so our tax savings in that case is about $2,500. We're still in the same tax bracket. And if you finance the truck, your interest would add $3,200 to your costs, and that becomes a business expense also. So now your income tax is down to $16,700, and you have saved $3,300 on taxes for that year. But then let's look at the costs. So let's say the vehicle went down in value $10,000, just like you depreciated it, and you spent $3,200 on interest, and you had a $3,300 tax savings. That vehicle, even after the tax savings, cost you $9,900 for that first year. So where I take this analysis is that, do you need a new pickup truck, and can you afford a new pickup truck? Even if you can finance it, you're going to have to be making payments. So